Hi guys, um, I would like to welcome all of you. I would like to welcome all of you for the two-day session of F6 taxation organized by ACCA Sri Lanka. Organized by ACCA Sri Lanka. So today I'll be taking 4 hours to do some revision for the students who intend to sit for the exam in December, on the 3rd of December. So today from 2 o'clock to 6 o'clock for a period of 4 hours, I'll be explaining few main areas of taxation, that is CGT, inheritance tax, and value added tax. You are very well aware that F6 taxation syllabus consists of mainly 5 areas. One is individual income tax computation. Then we have corp tax computation, then capital gains tax, inheritance tax, and value added tax, which is the only indirect tax that we have in our syllabus. Now, if you take capital gains tax, inheritance tax, and value added tax, if you cover those 3 areas compared to corp taxation and individual income taxation, the bulk is less. They're not that bulky compared to individual income tax computation and corp tax computation. However, you can definitely score substantial marks at the exam. So definitely, this is an area where I should focus on when you are preparing for your December exams. And these are 3 areas which you can complete within a very short span of time as well. Because if you take income tax computation and corp tax computation, there are a lot of areas that we have to cover, which I intend to complete tomorrow within a period of 4 hours. So today, as I mentioned previously, that I'll be covering inheritance tax, CGT, and value added tax. So straight away, let me start with capital gains tax. Now, here we mainly focus on capital gains tax computation for individuals. We have corporation capital gains tax computation as well. However, when we say CGT, it's specifically applicable to individuals. So in your F6 syllabus, we have 2 main areas for individuals. One is income tax computation for individuals and CGT computation for individuals. So if you look at your textbook, and if you are referring to Kaplan textbooks, there you will be able to see there are 4 chapters allocated for this purpose. So if you cover those 4 areas, 4 chapters actually, within, you will be able to score at least 10 to 15 marks at the exam, which is quite significant and substantial. But the workload, as I said, will be less. Now, when you take any tax computation, when you take any tax regime, mainly we have to look at who is the taxable person. The second thing that you have to look at is on what kind of disposals you have to pay taxes. And the third one is, do we have to pay CGT on each and every asset that we dispose? So there are 3 things that we need to look at. One thing, under CGT, who is subject to CGT? For the purpose of F6, it is always presumed that the individual is a UK resident individual. So we can come to a general conclusion, which is not 100% accurate, but for the purpose of F6, you can always assume that only UK resident individuals are subject to CGT. So if there is an individual, it is presumed that person is a UK resident person. Therefore, that person should be subject to CGT. Then we have to look at On what kind of disposals you have to pay CGT? What kind of disposals? Now, when you say a disposal, it can be a sale of an asset. It can be an exchange of an asset, gift of an asset, or even it can be damage of an asset or losing of an asset. Even if an asset has got destroyed, that is considered as a disposal for the purpose of CGT. Accordingly, remember in F6, there are two disposals which are exempt from CGT. Excuse me. One is death transfers. If you transfer something on the death of a person, that transfer is completely exempt from CGT. Then, on the other hand, if you make a charitable donation, if you make a donation to a charity, that is also an exempt disposal. That is an exempt disposal. So if you look at it, if you look at this slide, you will be able to see there are two types of transfers which are exempt from CGT. One is transfers on death, the other one is transfers to charity. Except for these two, everything else is a chargeable disposal for the purpose of CGT. Excuse. On the other hand, you would notice there are certain assets which are not subject to CGT. For an example, if you dispose your current assets such as inventory, trade receivables, cash in hand, cash at bank, that kind of current assets, and certain types of chattels are tangible movables. And on the other hand, gilt-edged securities, government securities, and there is something called qualifying corporate bonds. Now, these are exempt assets for the purpose of CGT. So you have to be very careful at the exam, because sometimes you might be given a set of assets and you'll be required to calculate the chargeable gain or allowable loss. However, if that asset is an exempt asset, you don't have to waste your time to calculate the chargeable gain or the allowable loss. So here, if you look at this slide, you'll be able to see certain examples for exempt assets. Then, how do you actually calculate the chargeable gain or allowable loss? It's a very simple computation. CGT is not a complicated area. There are some exceptional rules that we must be familiar with it. But if you look at the computation part, it's not going to be a complicated one. Now, for us to calculate the chargeable gain, we know as an individual, you're mainly subject to two types of taxes. One is income tax. Income tax is a tax that an individual has to pay on his taxable income. These are recurrent routine income such as employment income, trading income, property income, savings income, dividend income, etc. However, CGT is calculated on one-off transactions. These are disposals that we have made during the tax year. You know, when you're calculating income tax or CGT for individuals, you have to look at the tax year. And the tax year starts on the 6th of April 2018, ending 5th of April 2019. So we are currently in 2018-19 tax year. So during this time period, if you have made a chargeable disposal with regard to a chargeable asset, then you need to calculate either the chargeable gain or the allowable loss. So this is how you calculate the chargeable gain or the allowable loss. So you have sales proceeds. Now, when I say sales proceeds, you have to be really cautious here. There can be situations where you have gifted the asset. So if you have gifted the asset, you will be aware that there is no actual sales proceeds. Sometimes you would have sold the asset to a connected party. So there can be sales proceeds However, it can be an undervalued price than the market value. Now, in situations like that, remember, for the purpose of CGT, you have to ignore the actual sales proceeds, always rely on the market value. So if you have gifted the asset, there's no actual sales proceeds, it is zero, but still, as your deemed sales proceeds, you should take the market value. Even if you have sold the asset to a connected party at an undervalued price, still you have to take the market value as your deemed sales proceeds. So that's the first important rule that you need to remember. If you have sold the asset at the market value, then of course you can proceed with the market value when calculating the chargeable gain or the allowable loss. Then if you have any related expenditure with regard to sales, you can deduct those sales related expenditure from your sales proceeds. Then you get the net selling price, and then you have to deduct the cost of acquisition or any other capital expenditure, not revenue type of expenditure, but any type of capital expenditure can be deducted. So basically, it's the difference between your sales proceeds or the market value and the cost of purchase. So that difference can be a gain or else a loss. So that's how you calculate the gain or loss for an asset. Then you have to identify all the chargeable disposals that you have made during the tax year. Say you have sold 3 assets. For each asset, you have to calculate the chargeable gain or the allowable loss. For each asset, you have to calculate the chargeable gain or the allowable loss. Then you have to add everything together. Now, for an example, say asset A, you have sold, you have a chargeable gain of £12,000. So asset B, you have a chargeable gain of £13,000. But from asset C, you have a loss of £6,000. Then what you should do is add everything together and get the answer. The answer that you get here is £19,000. We call it the net chargeable gain. So that is the net chargeable gain. That is the net chargeable gain, 19,000. Now, this is not the value on which we are going to pay CGT. We are permitted to deduct another amount, that is what we call annual exempt amount. Annual exempt amount. So here we are entitled to an annual exempt amount of 11,700 for the tax year 2018-19. So for the current tax year 2018-19, we have an annual exempt amount of 11,700. So from the net chargeable gain, when you deduct the annual exempt amount, you get an answer, that is what we call the taxable gain. On that amount, we have to pay CGT at 10% or 20% if it is not an investment property. So I'll repeat again. So for each asset disposal that you have made during the tax year, you need to calculate the chargeable gain or the allowable loss, as I did here, and add them together. Then you get an answer, that is what we call net chargeable gain. From that, you can further deduct any annual exempt amount available, which is 11,700 maximum. Then you get an answer, that is what we call the taxable gain. On that, you have to pay CGT. There, it depends on whether the gain is arising from investment property or non-investment property. If it is something to do with residential property, then you have to pay CGT at either 18% or 28%. If you are a basic rate taxpayer, then the residential property gain will be subject to tax at 18%. And if you are a higher rate or additional rate taxpayer, in that case, you will have to pay CGT at 28%. But if it is not a residential property gain, then you will have to pay CGT either at 10% or 20%. That's all. Then when you're dealing with this, you can always take into consideration the capital losses brought forward available. Capital losses brought forward available. Now, there also students must be really careful. That is because the way we treat current year capital losses and brought forward capital losses are different from each other. If you have a current year capital loss, now in my example, we notice that there was a current year capital loss of 6,000. During the tax year, I have sold an asset at a loss of £6,000. That is what we call a current year loss. Remember that current year loss must be fully set off against the available chargeable gains. We don't have a choice when we are utilizing current year capital losses. Maximum possible amount must be set off against the existing chargeable gains available. In other words, current year capital losses cannot be utilized in a way that you can preserve the so-called annual exempt amount of 11,700. However, if you are going to utilize capital losses brought forward, remember, you can use it in such a way without wasting your annual exempt amount of 11,700. I'll repeat it again since it is something really important for you to remember. That is, when you're dealing with capital losses brought forward, you can decide how much you're going to utilize against your chargeable gains. So that can be done in such a way that you can preserve your annual exempt amount of 11,700. However, ultimately, you need to calculate the taxable gain, and on that you have to pay normally at 10% or 20% if you are a higher rate or additional rate taxpayer. So straight away, I will look at these questions that you have been shared with. You guys have already been shared with this PowerPoint presentation slides and some revision questions that I was planning to discuss during this session. Now, there, if you can download that document, under handouts, you can see practice questions. Look at practice questions. Open that document. In that document, look at question number 8. Look at question number 8. It says Columbus and Marco. Columbus and Marco. I hope that all of you have the question. It's there under handouts. You just have to click on it and download the document. And go to question number 8 in that. The question says Columbus and Marco. There are two parts to that question. So it's a simple, straightforward question. First one, it says Columbus sold one of his factories on 30th July 2018 for £900,000. The factory had been purchased in September 1989 for £300,000. In March 2019, Columbus purchased another factory for $700,000 and claimed rollover relief on the gain on the factory sold in July 2018. So under CGT, as I said, there are 4 main chapters allocated in your textbook. Out of that, the most important area that you have to focus on, the release available on capital gains, the release available. Under reliefs available for CGT, we learn mainly principal private residence relief, letting relief. Then we have something called ER or entrepreneurs relief. We have something called investors relief. We have rollover relief. We have gift relief or holdover relief. So these are the main reliefs that will be tested at the exam for sure. One such relief is, as I mentioned, rollover relief. It's a straight, it's not a complicated computation, but you must know the conditions that you need to satisfy in order to claim rollover relief. Basically, rollover relief is given when an asset is sold and that money is utilized to purchase a replacement asset. Both the old asset and the replacement asset must be qualifying business assets. They must be qualifying business assets. Now, what you have to do is you have to sell one qualifying business asset and the sales proceeds must be utilized to purchase another qualifying business asset. So we will look at the presentation slides applicable to that. So you can see on the screen. So this is the rationale behind this computation. This is the rationale. Disposal of and reinvestment. So what are these qualifying business assets? For the purpose of CGT, for as individuals, there are 3 qualifying business assets we identify. One is land and buildings, fixed plant and machinery. Third one is goodwill. And a very important thing to remember, now itself I will mention that even a company can claim rollover relief. Even a company can claim rollover relief, but a company cannot claim rollover relief on goodwill. But an individual who's running an unincorporated business, which is not a company, such as sole traders or partnerships, there you can claim rollover relief even on goodwill, in addition to land and buildings and fixed plant and machinery. One other thing to remember is you will never be able to claim rollover relief on shares. Rollover relief is not available on share disposals. And a very important thing is the asset must be used for the purpose of trading. So for an example, if you have a building, used it as a factory, then it's a qualifying business asset used for the purpose of trading. However, if part of the factory is let to some outsider, which is not used for the purpose of trading, then the full rollover relief will not be available. It will be restricted to the business usage percentage of the factory or the building. And another important thing that you can see here on the screen, that is the replacement must be done within a qualifying time period. So when you're dealing with a question at the exam, make sure that the old asset and the replacement asset both must be qualifying business assets. One other thing, it doesn't mean that the old asset and the new asset must be the same type of qualifying business asset. No, it's not the case. What matters is the old asset and the new asset both must be some type of a qualifying business asset. So you can sell land and factory, and then you can purchase goodwill or some fixed plant and machinery. Both must be some type of a qualifying business asset. That is the requirement. And as I mentioned a little while ago, the replacement asset must be purchased within the qualifying time period. So the qualifying time period you can see on the screen here. Sometimes you cannot wait until you sell the old asset to buy the new one. When you're running a factory, you will have to buy the new plant and machinery, new building, before selling the old one, because you have to continue with your trade, you have to continue with your business activities. So in that case, the new one will be purchased before selling the old one. If that is the case, if that is the situation, the new replacement asset must be purchased within 12 months prior to the disposal of the old one. Before selling the old one, within a period of 12 months, you have to buy the replacement asset. Sometimes it's convenient, you sell the old asset, collect the money, from that money you buy the new asset. So that must happen within a period of 36 months. So either you can buy the replacement asset within 12 months before disposing the old one, or within 36 months after disposing the old one. So you have to always make sure that it is within the qualifying time period. Now we'll look at how to do this computation. So now, according to this question, you would notice, when have we sold the old asset? The old asset we have sold 30th July 2018. So you can see 30th July 2018, we have sold the old asset. So that's the date we have sold the old asset. And then we have bought the new asset, and that occurred in March 2019. In March 2019. So March 2019, we have bought the new one. So you compare the two time periods. Old one, we sold it on the 30th July 2018, and within a period of 36 months, we have bought the new factory in March 2019. So that means this is within the qualifying period. So the transaction within the qualifying time period. Within qualifying time period. Within qualifying time period. And now we will look at, okay, how much is our sales proceeds from the old asset? How much is the sales proceeds from the old asset? So it's basically 900,000 pounds. It's 900,000 pounds. And then we have the cost of purchase. I'll just write it in short form, everything. I just want you to understand the calculations only, which is 300,000 pounds. Which is 300,000 pounds. So that you need to deduct. Then you get an answer. That is what we call the chargeable gain, which is 600,000 pounds. 600,000 pounds. So that is the chargeable gain. 600,000 pounds. Now this is the value that will be subject to rollover relief depending on the value of the new asset that we have purchased. Now the old asset we have sold for 900,000, which you have bought in 1989 for 300,000 pounds, which gives you a chargeable gain of 600,000 pounds. From the money you received, how much we received? 900,000 pounds. That is our sales proceeds, 900,000 pounds. So from that 900,000 pounds, we have bought a new asset for how much? The new asset we have bought for 700,000 pounds. 700,000 pounds. Now you need to make a comparison. You need to make a comparison here. What is the comparison that you have to make? The old asset you have sold for 900,000. The new asset you have bought for 700,000 pounds. What does it imply? It implies you have not fully utilized your 900,000 pounds to buy the replacement asset. You received 900,000 pounds, but you spent only 700,000 pounds to buy the new asset. New asset. That means you have not spent 200,000 pounds. You haven't spent 200,000 pounds. How did we get that 200,000 pounds? Old asset sold for 900,000 pounds, new asset bought for 700,000 pounds. That indicates we have not utilized 200,000 pounds to buy the replacement asset. That becomes chargeable immediately. So we currently have a chargeable gain of 600,000 pounds. However, out of that 200,000 pounds become chargeable immediately. The balancing figure, the balancing figure, 400,000. You have a chargeable gain of 600,000 here, 600,000. From that, 200,000 becomes chargeable immediately, and the balancing figure 400,000, that is the amount we can roll over. That is the amount we can roll over. We call it the rollover relief. Now what happens to this rollover relief? This 400,000 is postponed. Remember, rollover relief is not a relief which allows you to exempt your gains. It only helps you to postpone your gain. Now, currently you have a gain of 600,000 after selling this whole factory. However, 200,000 becomes chargeable immediately. That is because out of the sales proceeds 900,000, we did not spend the full amount. 900,000, we spent only 700,000. So the balance 200,000 becomes chargeable immediately out of the total gain 600,000. Then there's a balance figure of 400,000. That gain we can postpone to the future. We can defer it. We can roll over it against the cost of the new asset. So what we do is this 400,000, we deduct it against the cost of the new asset. So you need to deduct that value actually. You need to deduct that value. You need to deduct that value. $400,000. Then you get an answer that is what we call base cost, 300,000 base cost. This is the base cost of the new asset we purchased. So they're asking, calculate the chargeable gain on the sale of the first factory. The amount of any rollover relief available and the base cost of the second factory. 5 marks allocated for this question. So the chargeable gain was 600,000, out of which 400,000 we were able to roll over. 200,000 became chargeable immediately, and the base cost of the new assets is 300,000 pounds. How did we get that 300,000 pounds? From the cost value of the replacement asset, we deducted the rollover relief. At the same time, it's not part of this question. It's not part of this question, but I must tell you, there is some special rule that you need to remember. Now, this is how you do the computation when both the old asset and the new asset are non-depreciating assets, such as land and buildings. Now, If the replacement asset is a depreciating asset, make a note. The rollover relief available is little different. Normally, under rollover relief, whatever the gain that you are permitted to roll over will be deducted against the cost of the replacement asset that you have purchased. However, if the replacement asset is a depreciating asset, such as fixed plant and machinery, or an asset that can become a short life asset within the next 10 years, such as a lease with a lifespan of 60 years, we call them depreciating assets here. So if the replacement asset is a depreciating asset, remember you cannot deduct this 400,000 against the cost of the depreciating asset. I'll repeat it again since it's important for you to remember. If the replacement asset is a depreciating asset, whatever the gain rolled over cannot be deducted against the cost of the replacement asset. Instead, this 400,000 will be frozen. It will be deferred. It will be frozen, but it is not deducted against the cost of the new replacement asset that you purchased. Therefore, the cost of the replacement asset will remain at 700,000 if you take this example. So in this situation, if we assume that the replacement asset is a depreciating asset, then the cost will remain at 700,000. It will not be reduced by 400,000. Instead, the 400,000 gain will be deferred, postponed until the occurrence of one of the three events that I am going to disclose now. So if the replacement asset is a depreciating asset, in that case, the gain will be deferred, postponed. However, it will not be deducted against the cost of the replacement asset. Instead, this 400,000 gain will be frozen and it will crystallize if one of these three events occur, whichever the event occurred earliest. What are those three events? The date where the depreciating asset is disposed of. At some point, if you decide to sell the depreciating asset, at that point, this 400,000 frozen gain will become chargeable. Or else, the depreciating asset ceases to be used for the purpose of trading. After some time, you decide not to use the asset for the purpose of trading. Or else, it can be a situation where the depreciating asset has become obsolete, which has no value, you can't use it anymore, and you can't even sell it outside. Therefore, the depreciating asset is now ceased to be used for the purpose of trading. Or else, the third important one is after 10 years time period from the date of acquisition of the depreciating asset. So after purchasing the depreciating asset, within 10 years, after 10 years time, definitely this 400,000 will become chargeable. You can't prevent it. That is something you cannot prevent if the replacement asset is a depreciating asset. So we see a clear difference now. That is, if the replacement asset is not a depreciating asset, the gain can be deferred against the cost of the replacement asset, and it can be deferred until such time that you sell the asset one day. It can be 50 years, 100 years, 200 years. Until then, you can defer the gain. But if the replacement asset is a depreciating asset, even though you sell it or not, after 10 years time, this 400,000 pounds will definitely become chargeable. So in other words, if the replacement asset is a depreciating asset, the maximum time period where you can defer the gain will be restricted to 10 years time period. Only for 10 years you can defer the gain if the replacement asset is a depreciating asset. Then if you look at part B, very much similar. You can try it as homework. By the way, I will be sharing the answers for all these questions towards the end of the session, so you don't have to worry about it, about the calculations and everything. I will be sharing the answers towards the end of the session by tomorrow. So part B is very much similar to part A, so you can try it as homework. Then look at question number 9. Excuse me. Now, ACCA Part A, on 31st July 2018, ACCA gifted his 10% shareholding. There you need to highlight 10% shareholding. This is question number 9. Look at question number 9. So there ACCA on the 31st July 2018 gifted 10% of his shareholding in European Traders Limited to his daughter, Felicity. Oscar has never worked for the company. The agreed market value of the shares on 31st July 2018 was £550,000. Now you can see, as I mentioned at the very beginning, this is a gift of shares to your daughter. So when you're gifting your shares, you don't charge anything from the recipient. It's a pure gift. However, for the purpose of CGT, you need to consider which value? Not the actual sales proceeds, but the market value should be treated as your deemed sales proceeds. Oscar inherited the shares on 1st of August 2001 when they were valued at 125,000. Oscar and Felicity elected to hold over the gain. So if you look at question number 9 here, question number 9, there you would see you have deemed sales proceeds, which is the market value, 550,000. Then at which value you have acquired it? Now in this instance, Oscar has never bought these shares from anyone else. He has inherited these shares. On the death of someone, he has inherited these shares. So there your cost of acquisition is the market value which existed at the time you inherited these shares. You call it actually the probate value. You call it the probate value. That is the market value which exists at the time of the death of a person. So you didn't pay anything, but when you acquired the shares or when you inherited the shares on the death of someone, the value at that time was £125,000. That becomes your cost. Actually, that is also a deemed acquisition cost. Deemed cost, because it's not a real cost for you. You never paid this 125,000. So then you have 125,000, which is a minus figure, and then you get a chargeable gain of £425,000. £425,000. Now what do we have to do? This is the chargeable gain. Oscar and Felicity elected to hold over the gain. What do you mean by hold over the gain here? That means they have decided to claim the gift relief or hold over relief. A very important thing to remember. A commonly tested one at the exam, that is how to claim gift relief on share disposals. How to claim gift relief on share disposals. So this is the relevant part. Now, it's a gift. You don't receive any cash. So the person who's making the gift, we call him the donor. The recipient of the gift, you call that person the donee. There's no cash consideration exchanged here. Asset, the ownership of the asset is merely transferred at no consideration. Therefore, the donor does not receive any money. Therefore, HMRC gives you this special relief where you can postpone the gain again. Under gift relief or else under holdover relief, remember, like the rollover relief, you don't get any exemption. The gain will only be postponed. It will be deferred to the future. In other words, the donor gets the opportunity to transfer his burden, transfer his obligation to pay CGT to the recipient of the gift, which makes sense. It's quite understandable. I'm making a gift, I don't receive any cash, and on top of that I'm supposed to pay taxes, but under gift relief I get the opportunity to postpone this burden to the recipient of the gift. So if the recipient one day sells the asset, he will have to pay taxes on the deferred or the postponed gain. So we'll see how it works anyway. Most commonly tested disposal for the purpose of gift relief is share disposals. When it comes to share disposals, listen very carefully. There you need to consider whether the company is quoted or unquoted. Check whether the company is quoted or unquoted. That means whether the company is listed in the London Stock Exchange or not, listed or unlisted. If the company is a listed company in the London Stock Exchange, and if it is not a personal trading company, so it's not a personal trading company. You're very well aware, for the purpose of CGT, personal trading company means an individual owns at least 5% of the ordinary share capital of the company, which carries 5% voting rights. Leave it aside, but in simple terms, if you're holding 5% or more of the ordinary share capital of the company, then you call it a personal trading company. If you hold 5% or more, it's a personal trading company. So if it is not a personal trading company, that means you own less than 5% of the ordinary share capital of the company. Therefore, it's not a personal trading company. If it is not a personal trading company, then you need to check whether it's a listed company or unlisted company. If it is not a personal trading company plus it is a listed company, then remember, no gift relief whatsoever. So if you have gifted shares of a quoted and not a personal trading company, then there's no gift relief. But if even though it's not a personal trading company, if it is a non-listed company in the London Stock Exchange, then the full gift relief is available without any restriction. Now we come to the most important part where we have to use this formula. That is, if the company is a personal trading company, if the company is a personal trading company, that is, A company where the individual holds at least 5% of the ordinary share capital of the company, then it's a personal trading company. If it is a personal trading company, it is irrelevant to consider whether it's listed or unlisted. You don't have to find out whether it's listed or unlisted. If it is a personal trading company, gift relief is always available. If it is a personal trading company, it doesn't matter whether it's listed or unlisted, gift relief is available. But gift relief will be restricted to the proportion of this formula that we use. The gain, whatever the gain you calculate into the market value of CBA. CBA means chargeable business assets divided by market value of chargeable assets. Now look at question number 9, part A. There you can see we have gifted our shares when the market value was 550,000, which we have acquired or inherited when the market value was 125,000, which results in a gain of 425,000 pounds. Now we need to find out how much is the gift relief available. Now I ask you to highlight 10% shareholding at the very beginning. 10%. That's very crucial here. So whenever you are given a question, you should have the ability to find out the important information, important data given in the question. So 10% has a relevance in this question, in answering this question, which indicates that this is a personal trading company. If it is a personal trading company, it doesn't matter whether it's listed or unlisted, you have the gift relief. But the problem is, in this instance, the gift relief that you can claim, will be restricted. How do you calculate the gift relief? Your chargeable gain is how much? 425,000. Your chargeable gain is 425,000. However, you are not permitted to claim the full amount as your gift relief. It's because you're a personal trading company. In that case, you need to look at the value of your chargeable business assets and the chargeable assets. The question says the market value of the assets of the company at 31st July 2018 were land and buildings, shares held as investment, inventory, bank and cash balances, gilt-edged securities. Now, it says CBA, chargeable business assets. Here it says CA, chargeable assets. What are chargeable assets? Any asset which is not exempt from CGT. Any asset which is not exempt from CGT, we call it a chargeable asset. Okay, look at the list of assets that you have been given. Identify the assets which are not exempt from CGT. Land and buildings, of course, they are not exempt from CGT. Shares held as an investment, 200,000. No, it's not an exempt asset. Inventory. Inventory is an exempt asset. Current assets are exempt assets for the purpose of CGT. Bank and cash balances, exempt from CGT. Gilt-edged securities, we call them the government securities. These government securities are also exempt from CGT. Therefore, except for land and buildings and shares held as investment, everything else is exempt from CGT. So you ignore inventory, you ignore bank and cash balances, you ignore gilt-edged securities. Then you have two assets which are not exempt from CGT. We call them chargeable assets. So according to the example that you have been given, according to the example that you have been given, according to the example that you have been given, you have chargeable assets worth of 900,000 pounds. How did I get that answer? 700,000 pounds plus 200,000 pounds, 900,000. So these are your chargeable assets. These are your chargeable assets. Then there's another concept called chargeable business assets. So land and buildings, shares held as an investment, both are chargeable assets for the purpose of CGT. Then out of the chargeable assets, consider whether the asset is used for the purpose of trading or used for the purpose of business. If the asset is used for the purpose of trading or business, then we call it CBA, chargeable business asset. Chargeable business asset, CBA. So land and buildings, it is presumed that it is used for the purpose of business. Therefore, it's a CBA. But shares held as an investment, it is not a trading asset. It is not an asset used for the purpose of business. It is an investment asset. Therefore, shares held as an investment is not a CBA. It is a chargeable asset, but it is not a chargeable business asset. Therefore, you exclude 200,000, then you have chargeable business assets worth of 700,000 pounds. So then what you're supposed to do here, you take the chargeable gain, 425,000 pounds, and that you multiply it by chargeable business assets. We have only one here, which is 700,000 pounds, and divided by the chargeable assets available. Here we have two answers for that, two figures for that, 700,000 and 200,000. So you get 900,000 there. So to find out the total gift relief available, take the calculator, do the calculation with me. 425,000 divided by 900,000 pounds multiplied by 700,000 pounds. Then how much you get? You get 330,556. Double check my computation. So here you get the gift relief, holdover relief or gift relief is actually 330,556. This is how we got the answer. 425,000 divided by 900,000 multiplied by 700,000. So the gift relief is 330,556. You deduct it. 330,556. You deduct the answer. And then you get the chargeable gain after relief. Chargeable gain after gift relief. How much is that? Again, double check the computation. I get 94,444. 94,444. So this is your chargeable gain after the relief. Then one more thing. So this is the chargeable gain after the relief. Gift relief is 330,556. What happens to the gift relief? What happens to the gift relief? What happens to the gift relief? This 330,556, very much similar to the rollover relief. Under rollover relief also, what we did was we postponed the gain. Under gift relief also, it doesn't exempt your gains, it helps you to postpone the gain. It helps you to defer the gain. Therefore, this 330,556 is deferred, postponed against the deemed acquisition cost of the shares. What do you mean by deemed acquisition cost here? Now, I am gifting my shares to my daughter, I guess, when the market value is 550,000 pounds. So at the time of gift, what is the market value? At the time of gift, the market value is 550,000. So basically, the donee, the recipient of the shares of this 10% shareholding, acquires these shares when the market value is 550,000. He doesn't pay anything to get these shares, but for the purpose of CGT, 550,000 should be treated as his acquisition cost, deemed acquisition cost, which is the market value at the time of the gift. However, I have now claimed the gift relief. Therefore, I need to deduct the gift relief here. The gift relief is 330,556. That must be set off against the deemed acquisition cost of the shares. Then you get an answer that is what we call the base cost, BC, the base cost. How much is the base cost here? 219,444. So this is my base cost. My means here the recipient of the shares. So the recipient of the shares, the donee of the shares, acquires the shares at a value of 219,444. So at some point, if I decide to sell these shares that I received as a gift as my cost, I should deduct not 550,000 but the base cost of 219,444. So that will be my that's how I should calculate my chargeable gain if I decide to sell these shares in the future. Then if you look at part B, very much similar to part A, so you can try that question also as homework, and as I promised, I will be sharing the answers by tomorrow. Then you guys are aware that we have very limited time to discuss most of these questions and most of these areas. It's a vast syllabus. So when it comes to CGT, I was able to pick only rollover relief and the gift relief. However, when you're studying for the exam, make sure that you spend ample time to study ER, entrepreneurs relief. Investors relief can be tested, but not with a computation, as they are not in a position to check your knowledge with regard to the computation of investors relief due to a technical reason. That is because for you to claim the investors relief is available only on unquoted shares. You should not be an employee of the company, and it is only available on unquoted shares. And there's a very important condition, that is you should hold these shares for a period of 3 years starting from 2015-16 tax year. So basically you will be able to complete this 3 years time period only in 2018-19. Until 5th of April 2019 you cannot satisfy the 3 years time period requirement, because this was introduced in 2016-17, this investors relief. Therefore you don't have to worry about it. There won't be any computations, but you must be familiar with the conditions that are to be satisfied in order to claim the investors relief. However, a highly examinable relief is entrepreneur's relief. Entrepreneur's relief is a relief that will not exempt the gain, and it will not help you to postpone the gain either, but it will help you to pay CGT at a rate of 10% only, though you are a higher rate or additional rate taxpayer. Normally, if you are a higher rate or additional rate taxpayer, you have to pay CGT at 20% if it is non-residential property gain. If it is residential property gain, then you have to pay CGT at 28%. If you are a basic rate taxpayer only, you have to pay taxes only at 10% or 18% if it is residential property gain. But if your disposal qualifies for the purpose of ER or entrepreneur's relief, in that case, even though you are a higher rate or additional rate taxpayer, up to a lifetime limit of 10 million, you have to pay CGT only at 10%. Up to a lifetime limit of 10 million, you have to pay CGT only at 10% if the disposal qualifies for the purpose of ER. So what are these disposals qualifying for ER? If you are selling the whole business, we'll go through the PowerPoint presentation slides for you to get a better understanding. So you can see entrepreneur's relief is only available for individuals. It's not available for a company. Now, at the same time, I can make a small comparison because we have 2 more weeks for the exam. So by now, I'm sure that you are familiar with the basics with regard to capital gains tax. And there, as I mentioned at the very beginning, I'm doing this CGT computation for individuals, not for a company. A company also has to pay taxes on their chargeable gains, but a company is not subject to capital gains tax. If the company has a chargeable gain, then the company has to pay corp taxes on their chargeable gain. But the calculation is very much similar in comparison to an individual. But remember, when it comes to individuals, there are several reliefs available. Principal private residence relief, letting relief, entrepreneurs relief, investors relief, rollover relief, and gift relief. There are 6 reliefs mainly. But for a company, under F6 syllabus, we discussed only one relief available on chargeable gains, that is rollover relief. For a company, the only relief available on their chargeable gains is the rollover relief. There's nothing called PPR relief, letting relief, investors relief, entrepreneurs relief, gift relief for a company. They only have rollover relief. So just an additional thing for you to remember. Anyway, even for an individual, if you want to claim the entrepreneur's relief, a very important thing to remember is it's not available on disposal of individual assets. It has to be an asset used for the purpose of business. It has to be an asset used in the trade of the business. Now, if it is an asset used for private purposes or investment purposes, the entrepreneur's relief is out. It's not available. So first of all, check whether it's a business asset. Even though it's a business asset, if you are selling an asset in isolation, individually, then again the entrepreneur's relief is not available unless you cease trading. I'll come to that later. But if it is an ongoing business, From that business, if you sell an asset, remember, you cannot claim entrepreneur's relief, because the main requirement is for you to claim the entrepreneur's relief, you must sell the whole business or substantial part of the business. For you to claim ER, you must sell the whole business or substantial part of the business. Excuse. So what do you mean by the whole business? It's quite straightforward. I'm running a business, maybe as a sole proprietor, or else I'm a partner of a partnership. My partnership share or my sole proprietorship, I sell it to someone else completely. Then on the assets disposed of, I can claim the entrepreneur's relief because I have disposed the whole business. What do you mean by substantial part of the business? Substantial part of the business is a situation where I'm not selling the whole business. However, I'm selling, say, I have a branch. I'm selling that branch. So I still continue with the business, but I'm selling a very important part of the business, a substantial part of the business, a branch of the business. Then still I can claim ER, but not when I am selling my assets in isolation. However, a very important thing to remember is that for you to claim this ER, you need to own the assets at least for a period of 12 months. Before the disposal, prior to the disposal, you have to own the asset at least for a period of 12 months. Then only you can claim ER. So it has to be a substantial part of the business or disposal of the whole business, and the assets must be owned by the individual at least for a period of 12 months. But there's one situation where you can still claim ER, though it's an individual asset disposal. That is, assume you have decided to cease trading, you have decided to wind up the business, and no one is going to buy the whole business. Assume it's a bankrupt business, no one is going to acquire it, no one is going to buy it. So you have decided to cease trading, you have decided to close down the business without selling the business. However, whatever the individual assets available in the business, you will try to sell it anyhow, individually, in isolation. You will try to sell it because now you have ceased trading, you have decided to wind up the business. If that is the case, even though you are selling your assets individually in isolation, since you are selling them from a business where you have now ceased trading, if that happens within a period of 3 years from the date of cessation, then still you can claim entrepreneur's relief. It's a very rare situation that has been tested at the exam, but since it's there in the syllabus, you must be familiar with it. So you have decided to wind up the business, cease trading. You are not selling the business, but you are trying to sell the assets in isolation. You call it piecemeal basis, and you're selling them individually in isolation, but still you can claim ER if you sell these assets within a period of 3 years from the date of cessation. But most commonly tested one with regard to ER is actually share disposal. For you to claim ER on a share disposal, a very important thing that you need to remember, you need to satisfy 3 conditions. If you don't satisfy these 3 conditions, you cannot claim ER on any type of share disposal. Number 1, you have to be an employee of the company. You have to be an employee of the company. If you were not an employee of the company, you cannot claim ER. Then the second one is you should own these shares at least for a period of 12 months. You should own these shares at least for a period of 12 months. Third condition that is to be satisfied, it has to be a personal trading company. I have already explained the definition of a personal trading company. That is a situation where an individual owns at least 5% of the ordinary share capital of the company. If all these three conditions are satisfied, then only you can claim entrepreneur's relief on your share disposals. I'll repeat again, you must be an employee of the company, you must own these shares at least for a period of 12 months, and it has to be a personal trading company where the individual owns at least 5% of the ordinary share capital of the company. Then you can claim entrepreneur's relief. So a very important area, again, like rollover relief and gift relief, where students must focus on if you intend to sit for the exam on the 3rd of December. Then principal private residence relief is there, letting relief is there, and investors relief. So with the limited time period, I may not be able to explain each and everything. However, you must familiarize yourself with those reliefs as well. However, gift relief, rollover relief, and entrepreneurs relief are extremely important for the exam. Principal private residence relief and letting relief are available on your main residence, residence or principal private residence. So principal private residence relief is simply available if you're selling your main residence. If you sell your main residence, the whole gain is exempt. That is the residence where you have lived during your lifetime. Prior to the date of disposal, throughout the time period, you have occupied your main residence. That is a place where you have lived. Then in that case, you can claim the principal private residence relief. But the main condition that you need to satisfy in order to claim the principal private residence relief is that during the period of ownership, you need to occupy the main residence. If you have owned the asset, say for 300 months, throughout these 300 months, you must occupy the main residence. However, HMRC is flexible when it comes to occupation. Occupation is not restricted to actual occupation. Actual occupation is favorable, but it is not a must for you to have actual occupation. Even in situations where you have not actually occupied the main residence, still you can claim PPR relief, provided you satisfy certain conditions. We call them deemed occupation rules. So under PPR relief, you need to remember how to calculate the relief, the gain divided by the period of ownership, multiplied by the period of occupation. Then you need to find out what is my period of occupation. Period of occupation is not restricted to actual occupation. It is extended to deemed occupation as well. What is deemed occupation? There are 4 rules pertaining to that. Number 1, last 18 months, even though you occupied the main residence or not, even though you were absent from your main residence during the last 18 months, still it is treated as occupation, deemed occupation. Then any time period can be treated as deemed occupation if you have left the country for the purpose of full-time employment abroad. So if you have left the country for the purpose of employment, any time period is considered as deemed occupation. Say for 5 years you are absent from the main residence because of employment abroad, then all 5 years can be considered as occupation, though you are absent from the main residence. Then you can take 48 months, 4 years actually, 48 months as deemed occupation if you are employed in the UK, not overseas. If you are self-employed in the UK or overseas, up to 48 months, you can claim deemed occupation. In addition to that, due to any reason, you can go up to 36 months. However, except for the last 18 months rule, for all the other 3 deemed occupation rules that I mentioned, there is a there is an important condition to be satisfied. This important condition is not applicable to last 18 months. Last 18 months is unconditionally deemed occupation. However, the other three deemed occupation rules that I mentioned are subject to a condition, that is, before your absence and after your absence, at some point you should have actually occupied your main residence. So if you are employed abroad for 5 years, yes, you can claim all 5 years as deemed occupation, but before your absence and after your absence, at some point you should have actually lived in that main residence. If that condition is not satisfied, then you cannot claim that 5 years as deemed occupation. So for anything that you study, actually, for anything that you study, remember this: every relief that I mention has some key areas to remember. So spend enough and more time to understand these key important areas. Then when you are allocating time to understand the key areas, then the balance can be understood very quickly and easily. Now, under PPR relief, first you should know the formula that we use. The gain divided by period of ownership multiplied by period of occupation. Then you should know what you mean by period of occupation, that is extended to deemed occupation as well. Then you need to memorize the deemed occupation rules. There are 4. Out of 4, except for last 18 months, the other 3 are subject to a prerequisite, a condition. So you need to remember the condition. Then you understand PPR relief. The rest, the calculation is not going to be difficult. Letting relief is, on the other hand, available in a situation where you let the main residence while you are absent from the property. This is an easy way that you can make your gains exempt, actually, where you can make your gains exempt. That is, while you are absent from the property, since the gain can become chargeable, what you can do is let the property to someone before you leave. While you are absent from the property, let the property. Then the letting relief will be available. Under letting relief, you have to remember what is the maximum letting relief that you can have. And you can see it on the screen. It is the higher of, it is the lowest of the maximum letting relief that you can have is the lowest of £40,000. And then the normal PPR relief answer that you get, or gain, that is attributable to the letting period. From the 3 answers, you get the lowest figure, and that is your letting relief. So that's how you calculate it. So these are the important reliefs for the purpose of CGT. And under CGT, before I move to the next area, inheritance tax, I must tell you that under CGT, make sure that you have a very good understanding about the reliefs available, especially ER, rollover relief, gift relief. In addition to that, PPR relief, letting relief, and theoretical aspects of investors relief, the conditions that are to be satisfied. So you will be definitely tested with regard to the release of CGT. Then on the other hand, always look for share disposal questions at the exam. There can be share disposal questions most of the time. Now, when it comes to share disposals, remember there are some special rules that you will have to apply, especially if you have gifted shares. If you have gifted shares, I told you special gift relief is available. Special gift relief available on share disposal depends on whether it's a personal trading company or not, whether it's a listed company or not. So remember that special application of gift relief when it comes to share disposal. And then share disposals may qualify for ER. Then I told you there are three conditions we need to satisfy in order to claim entrepreneur's relief on share disposal. For us to claim gift relief on share disposal, we have to check whether it's a personal trading company or not, whether it's listed or not. For us to claim ER, entrepreneur's relief on share disposal, there are three conditions to be satisfied. I mentioned about the three conditions. And when it comes to share gifting, remember you have to always use the market value. And when you are using the market value also, there is a special rule that you need to remember. When you are gifting of shares, there's no actual sales proceeds, then you have to find the market value. How do you find the market value? If it is a listed share, you have to take the average list price or mid price. So every share has a list price. So that list price can be the lowest and the highest. You take both and take the average or the mid price, and based on that, find out the deemed sales proceeds when you're gifting shares to someone. So mid price or the average list price must be taken into consideration as your market value when you're gifting shares or when you're selling your shares to a connected party. So that's another important thing to remember. And then for the exam, make sure that you're familiar with takeovers and acquisitions. Now, I will briefly explain, not with a question, but since it's an important area where you must focus on, I will briefly explain. Let's focus on this and see whether you understand it properly. That is, an acquisition or else a takeover of a company. A, say, person X buys 10,000 shares in company A. So he's a shareholder of company A with 10,000 shares. But this company A is taken over by another party, another company. Say another company has bought over company A. Say company B has acquired company A. Then what happens? Company B becomes the shareholder of company A. In other words, I have to sacrifice my shares. I have to let go of my shares that I have in company A, and I should transfer those shares to company B now. That is what happens in a takeover. So my shares are bought over by some other person, some other company. If they pay me cash, I just need to calculate the chargeable gain. But sometimes in a takeover, what happens is the takeover company, the predatory company, in my example, company B, without paying me cash, they will give me their shares in return of the shares I had in company A. Effectively, what happens is I become a shareholder of company B instead of being a shareholder of company A. Earlier, I was a shareholder of company A with 10,000 shares. After the takeover, I become a shareholder of company B. This is what we call a share for share exchange. Paper for paper exchange. No cash involved. Since there is no cash involved, only the portfolio has changed. Instead of me being an investor of company A, now I become an investor in company B. The nature of my shareholding has now changed. That's all. Instead of the shares I had in company A, now I have shares in company B. Share for share exchange. Share for share exchange is considered as no gain, no loss. No gain, no loss. So you don't have to calculate the chargeable gain or the allowable loss. However, if there is mixed consideration, that means sometimes Due to a takeover, when a takeover happens, company B might give me company B shares and little um, here you can see on the screen, this is how you calculate the part disposal gain, cost of the part disposal, cost into A divided by A plus B. This is a very important computation. Then just to complete, for the purpose of completion, when it comes to CGT, spend little bit of time to understand uh, wasting chattels and non-wasting chattels. I'll briefly explain the meaning as well. Chattels are tangible movables. Chattels are tangible movables. The CGT implications depends on whether the chattel is a wasting chattel or non-wasting chattel. A wasting chattel is a chattel with an expected lifespan not exceeding 50 years. So if the lifespan of the chattel is limited to 50 years, we call it a wasting chattel. If the lifespan is more than 50 years, we call it a non-wasting chattel. If it is a wasting chattel, the rule is wasting chattels are exempt from CGT. Example, animals used for the purpose of hunting, such as greyhounds, then a boat, race horses. Now, those are wasting chattels. If you sell them, they are exempt from CGT, except for plant and machinery. So when it comes to wasting chattels, the general rule is they are exempt from CGT. They are exempt from CGT. But there's an exception. Exception is plant and machinery. Plant and machinery are treated as deemed wasting chattels. They are always treated as wasting chattels, plant and machinery. So if you sell your plant and machinery at a profit, at a gain, that is subject to CGT. Normally, I'll repeat myself, wasting chattels are exempt from CGT. However, if it is plant and machinery sold at a gain, though it's a wasting chattel, it is not exempt from CGT. However, if you sell your plant and machinery not at a gain but at a loss, that loss is not an allowable loss. No relief is given for that allowable loss under CGT because a relief has already been given under normal capital allowance computation. Just memorize it like this. Wasting chattels are exempt from CGT except for plant and machinery sold at a gain. If plant and machinery sold at a loss, then that loss is not an allowable loss, as you have already been given a relief under capital allowance computation. Then on the other hand, if you take non-wasting chattels such as leases and fixed plant and machinery, now these non-wasting chattels, if that is the case, non-wasting chattels, mostly you get fixed plant and machinery, immovable plant and machinery. There, They are not exempt from CGT. However, these special rules that appears on the screen will be applicable. You have to be familiar with these special rules. Take your time to go through it. This is applicable when it comes to non-wasting chattels. Normally, if it is a non-wasting chattel, it is chargeable for the purpose of CGT. However, if it is, here you can see, bought and sold for £6,000 or less, then it is exempt. Bought and sold for £6,000 or less, then it is exempt. But if it is bought and sold for more than £6,000, then the normal gain computation is applicable. Otherwise, these special rules are applicable. This is what we call 6,000 rule. As I mentioned previously, any student who is planning to sit for the exam in December must be familiar with this 6,000 rule as well. Okay, so in a nutshell, what do we uh, need to understand? What do we need to learn under CGT? First of all, you should know who is a chargeable person. We learned it's a UK resident individual who will always be subject to CGT, and it has to be a chargeable disposal. I told you the debt transfers to the charities, they are exempt disposals. Other than that, everything else is a chargeable disposal, including a destruction of an asset, losing of an asset. Even though the asset has got damaged, and if the asset is insured, in that case, it is a chargeable disposal. Then there are assets which are exempt from CGT. There are assets which are chargeable for the purpose of CGT. So must be familiar with it. And then there are some special rules pertaining to CGT computation. One such special rule is applicable when it comes to part disposal computation. When it comes to wasting and non-wasting chattel computation, especially non-wasting chattel computation, which is subject to £6,000 rule. Then on the other hand, when you are calculating the value, the sales proceeds, when you are gifting shares, you need to take the average list price or the mid price. Then we learned takeovers, mergers and acquisitions, share for share exchange, special rules are applicable. And one important thing which I forgot to mention, interspouse transfers. Interspouse transfers, husband and wife transfers between husband and wife. If an asset is transferred between husband and wife, always at no gain, no loss. It's like that share for share exchange disposal. So these are special rules that you must be familiar with it. And then we need to learn, we need to be familiar with the release available. Under that, I told you there are 6 release available. Out of that, rollover relief, entrepreneurs relief, and holdover relief are extremely important. So those are the main elements and aspects of CGT. So I hope that you were able to get a basic understanding with regard to CGT. And for the purpose of completion, again, other than the things that I mentioned, you must be familiar with the computation of CGT as well. That is something I explained at the very beginning, how to calculate the taxable gain. And then based on the taxable gain, based on whether you're a basic rate taxpayer, high rate or additional rate taxpayer, you have to pay CGT either at 10 or 20. And if it is residential property gain, in that case, you will have to pay taxes at 18% or 28%. And if you are still fall within the category of basic rate band, which is 34,500. So if your gain falls within the first 34,500, which is the basic rate band, then you pay at 10 or 18% if it is residential property gain. If your gain falls above the basic rate band of 34,500, then you have to pay at 20% or 28% if it is residential property gain. However, if you can come under entrepreneurs relief, if the disposal qualifies for entrepreneurs relief, in that case you can pay CGT at 10% up to a lifetime limit of 10 million. So those are the important elements of CGT. So we'll take a short break and for a period of 10 to 15 minutes, and then once I come back, I will explain inheritance tax. So we'll take a short break and see you in another 10 to 15 minutes time. Thank you. Hi guys. Uh, so we'll continue with the new topic. So the next important area that I'm going to discuss within the remaining time period is that inheritance tax. So when it comes to inheritance tax, I have mentioned this in my classes also to my students, that is small area but a very important area, as you can definitely score at least 10 marks from this area at the exam, but only one chapter is allocated for this purpose at the exam, in your textbook actually. So there, bear with me. Okay, so inheritance tax is basically a tax that is levied or charged when an individual receives a gift. Most of the time, when an individual inherits something on the death of a person, that means without paying a penny, on the death of a person, freely as a gift, if you receive something, then that transfer is also subject to a tax which is known as inheritance tax. However, the concept is not restricted to the transfers made on the death of a person. It is actually extended even for the transfers made during the lifetime of a person. So when it comes to inheritance tax, that is the main area where the students must be careful of. That is, not only death transfers, even the lifetime transfers are subject to inheritance tax. And again, this is a capital tax. Like capital gains tax, this is also a type of capital tax charged again on individuals. Now, as I said, the complications are there mainly with regard to the lifetime transfers. So today we can do few questions from this area for us to understand how the inheritance tax computation must be done. But before that, let me quickly run through the basic elements of inheritance tax. So there are, as I said, lifetime transfers are subject to inheritance tax, not only death transfers. When it comes to lifetime transfers, we can identify three types of lifetime transfers. One is exempt transfers. The transfers or the gifts made by one person to another person, which is completely exempt from inheritance tax, such as small gift exemption, where one individual gives something to another individual and the value does not exceed 250 pounds per person per annum. In that case, it is considered as a small gift and it's completely exempt from inheritance tax. Likewise, there is something called marriage exemption, where a gift is made in consideration of marriage, and depending on the relationship that the donor has with the donee or with the couple who are getting married, you get an exemption. Accordingly, if the parents of the couple who are getting married give something in consideration of marriage, up to £5,000, it will be exempt. Then if the gift comes from grandparents or ancestors, or from the bridegroom to the bride, or from the bride to the groom, so if they're exchanging gifts as a couple in consideration of marriage, then up to £2,500 will be exempt. If the gift comes from any other party, which I did not mention previously, then up to £1,000 it will be exempt. So if the parents decide to make a gift of £7,000 in consideration of marriage, that means up to £5,000 it will be exempt. Balance 2,000 will become chargeable. But when it comes to small gift exemption, remember, it has to be a gift made by one individual to another individual. From one individual to another individual. It cannot be a non-individual. It cannot be to a business. For you to claim the small gift exemption, it must come from one person, one individual, to another individual. Then on the other hand, we have something called annual exemption. Annual exemption is available for each tax year up to a maximum of £3,000. Any unused annual exempt amount can be carried forward maximum 1 year. So if there's any annual exempt amount which you have not been able to utilize completely, any unutilized annual exempt amount, we can carry forward maximum 1 year. But remember, first you must use the current year one prior to the usage of the previous year one. That's an important thing to remember when you're doing lifetime transfers. So there are exempt transfers like that. In addition to that, there are two other important lifetime transfers. On the screen, you can see them. We call it potentially exempt transfers and chargeable lifetime transfers. Potentially exempt transfers and chargeable lifetime transfers. We call them PETs and CLTs. Now, what's the difference between a PET and a CLT? We have to start IHT while understanding or while distinguishing the two types of lifetime transfers, PETs and CLTs. PETs are situation where a gift is made by one individual to another individual, then you call it a potentially exempt transfer. An individual makes a gift to another individual, you call it potentially exempt transfer. On the other hand, if an individual makes a gift to a trust, then we call it a chargeable lifetime transfer. So if it is a PET, there is no immediate IHT. At the time of making the transfer, there's no immediate IHT. However, if the donor dies within a period of 7 years from the date of gift, there will be possible IHT. If the donor does not die within 7 years, that means if the donor dies only after 7 years from the date of gift, then the potentially exempt transfer becomes a completely exempt transfer. There won't be any IHT. But when it comes to a CLT, where an individual makes a gift to a trust, we call it a CLT, there can be immediate IHT. At the time of making the transfer, during the lifetime of the individual, there can be immediate IHT. In addition to that, If the donor dies within 7 years from the date of gift, there can be further IHT. If the donor dies after 7 years, won't be further IHT. So those are the main differences. And you must remember that IHT is based on an important value called transfer of value or diminution in value. What do you mean by transfer of value? Now, for the purpose of CGT, we learn the basis of assessment is basically the difference between sales proceeds and the cost of purchase. The difference, we call it the chargeable gain, the difference between sales proceeds and the cost of purchase. But for the purpose of IHT, inheritance tax, what we look at is not the value of the gift. What we look at is, as a result of the gift, what happens to my standard of living, what happens to my wealth, what happens to my net assets in terms of accounting. So what you have to compare here is what was my wealth before making the gift, what is my wealth after making the gift. So before making the gift, assume I had net assets or I had a wealth of 800,000 pounds. After making the gift, my wealth comes down to 500,000 pounds from 800,000. That means the transfer of value is 300,000. IHT computation should be based on that transfer of value, which is 300,000 pounds according to my example. So it is something, it is a tax based on something called transfer of value or diminution in value. And there are two types of lifetime transfers, potentially exempt transfers and chargeable lifetime transfers. And we must be familiar with the differences. And the most important thing when it comes to inheritance tax is actually the computation part. If you are thorough with your computation, if you are thorough with your IHT computation, that is actually a blessing, because you can easily score very good marks if you know how to deal with a normal inheritance tax computation, the structure or the format that you have to use whenever you're doing an inheritance tax computation. And when you're studying for inheritance tax, focus a lot on the application of the nil rate band computation, which is extremely important for your examination purposes, how to deal with the nil rate band computation. So we will look at this question and then we will go through the answer to see how we should use the relevant format for the purpose of inheritance tax. So you can look at question number 10. Look at question number 10. Lewis and Gita Major. So look at that question, question number 10. We'll read it together. Excuse me. Lewis, a retail solicitor, is married to Geeta. Both of them are generally in good health. Lewis and Geeta have 3 children, Peter, John, and Carol. John married Joanne on 20th June 2012. The market value of Lewis and Geeta's assets at 12th March 2019 are as follows. Excuse. Main residence, building society accounts, premium bonds, equity, ISAs. One important thing to remember, unlike for the purpose of CGT or income tax or any other tax purposes, there's nothing called exempt assets for the purpose of IHT. Any asset is a chargeable asset for the purpose of inheritance tax. So here we have main residence, building society accounts, premium bonds, equity, ISAs, nothing called exempt assets for the purpose of IHT. Their history of lifetime giving is as follows. So as of 12th of March 2019, these two individuals are having these assets. And then during their lifetime, Lewis has made a lifetime gift. Date 20th March 2012. The recipient is John, one of his children. and the amount is 24,000. And 20th March 2012, they have made the gift. And then Geeta has made a lifetime gift. The date is 15th of December 2013. The recipient is Carol, another child of both Louise and Geeta. The gift on the 20th March 2012 to John was made on the occasion of his marriage to Joanne. Very important. So that was a gift. This 24,000 is a gift that was made in consideration of marriage. Whose marriage? Louise's child, Louise's son, John. So Louise as a parent has made a gift to John when he was getting married worth of 24,000. Then do not forget, you can claim the marriage exemption up to a maximum amount of 5,000 pounds. Then Louise and Geeta have reciprocal wills which leave 85,000 comprising cash and ISAs to each of their children, with the residue to each other on the first death and everything to the children in equal shares on the second death. So that part we need to understand properly. It sounds little confusing, but if you read it once again several times, you will be able to understand it. I'll come to that in a while. Then required, calculate the amount of inheritance tax payable on each death and the total inheritance tax payable, assuming that Louise dies on 12th of March 2019 and Geeta dies shortly after. So we have to assume that Louise is going to die first and then Geeta is going to die. Then first Louise is going to die and Geeta dies shortly after. Show clearly any exemptions available. You should assume that the values of the estates and the tax rates and allowances in the tax year 1819 remain unaltered at Geeta's death, and also all the lifetime gifts are made within 7 years of both deaths. Then we have been given some important figures with regard to nil rate band for the tax year 2011-12 and 13-14. So we will look at how to answer this question. So I have this model answer, so we can go through it. First of all, we need to deal with the lifetime gifts of Louise and Geeta. So we'll take Louise in this situation. So here you can see on the screen the way that we have done the calculation. So we'll go through it carefully. So when it comes to Louise, he has made only one lifetime gift. That was on the 20th March 2012. I'm going through this because, as I said, the most important part here is understanding the format. If you understand the format for the purpose of IHT, then you know more than 80-90% of inheritance tax, where you can score significant or some substantial marks at the exam. Okay, so it's a gift made by Louise to John, so it has to be a pet. So you mention in your column, it's a pet gift to John, and that occurred on the 20th March 2012. If you have more than one gift, you have to take them according to their chronological order. You have to take them according to the chronological order, starting from the earliest one. But in this instance, Louise has made only one lifetime gift, and the value is 24,000 pounds. Then you need to consider whether there are any special exemptions available. As I mentioned at the very beginning, this is a gift made by Louise to John when he was getting married. Therefore, the marriage exemption is available, And as I said, it depends on the relationship between the donor and the donee, here father and son, parent-children relationship. Therefore, the maximum relief available is £5,000. First, you must consider the special exemptions, small gift exemption, then this marriage exemption. After that only, you need to consider any annual exempt amount available. This is the only lifetime gift that he has made. Therefore, he can first use his current year annual exempt amount. Now, the gift was made 20th March 2012. So 20th March 2012 falls into which tax year? 2011-12. So use the current year annual exempt amount first. You can't change this. First the current year one. Then if there's any unrelieved amount, then you can use the previous year's carried forward amount. Since this is the only lifetime gift that you have made, no previous gift. No previous gift. Therefore, the last year's 3,000 you can freely carry forward to this year. Accordingly, you have 6,000 there, 5,000 as your marriage exemption. Then altogether, you have a chargeable amount of £13,000. You have a chargeable amount of £13,000, so you can see it here. Now, this £13,000, this £13,000, this £13,000, you call it the chargeable amount. You call it the chargeable amount. Now, for the purpose of IHT, there are two chargeable amounts. One is gross chargeable amount, the other one is net chargeable amount. If it is a pet, there's no doubt this is the gross chargeable amount. Without a doubt, this is the gross chargeable amount. This is the gross chargeable amount. So this is a gross figure. This is the gross figure. Then, since it's a pet, no immediate IHT. There's no lifetime tax as the gift is a pet. So no immediate IHT. You just calculate the chargeable amount, and that has to be the gross chargeable amount, and you carry forward for a period of 7 years. So if the donor dies within 7 years, then only this 13,000 will become chargeable. Okay, so the gift was made on the 20th March 2012. 20th March 2012. Then what you see, we have to assume that he died on the 12th of March 2019. So basically, exactly within 7 years, he has died. Exactly after 7 years from the date of gift, he has died. So basically, I'm sorry, from 20th March 2012 to 20th March 2019. So he has died on the 12th of March 2019. So he has died within a period of 7 years. Therefore, this 13,000 becomes chargeable now. Why? The donor died within 7 years. Donor died within 7 years. That's the reason. But that happens on the 12th of March 2019 during the tax year 2018-19. 2018-19. He dies on the 12th of March 2019 during the tax year 18-19. The gift was made on the 20th March 2012. It was a pet, no immediate IHT. There was a gross chargeable amount of 13,000 which we carried forward, and it now became chargeable because the donor died within a period of 7 years. So this 13,000 now becomes chargeable. Then what you have to look at is, okay, you start the computation here. Gross chargeable transfer brought forward, which is 13,000 pounds. Then you have another option to waive off your obligation to pay IHT. That is what we call, as I mentioned, a very important one. We call it nil rate band. Nil rate band. So this nil rate band is extremely important. Understanding how the nil rate band functions, how it works, is the most important part in inheritance tax. When you made the lifetime gift, if it is a pet, you don't have to use the nil rate band. That is because there's no IHT for pets. So you ignore the nil rate band when it comes to pets during the lifetime. But now it has become chargeable, then you have to use the nil rate band available. But what is the nil rate band you have to use here? Is it the nil rate band available at the time of gift, or are we going to use the nil rate band available at the time of death? Now we must remember this, that is, this potentially exempt transfer became chargeable not because of anything else. It became chargeable because the donor died on the 12th of March 2019. That is why the pet became chargeable. And that happened due to the death of the person in the tax year 2018-19. Therefore, you must use the nil rate band available in 2018-19. The nil rate band available at the time of the death of the person, which is 325,000 pounds. So nil rate band is basically an amount which we can consider for a period of 7 years. So within a period of 7 years, we can use this nil rate band and cover up whatever the chargeable amounts in a way that we don't have to pay IHT. Now here, if you look at this example, I'm using the nil rate band available at the time of the death of the person. However, I need to go back 7 years from the date of gift. Very important thing to understand. Students make mistakes when it comes to these things. I am using the nil rate band available at the time of death. That is true. But I must go back 7 years from the date of gift. The gift was made in 2012 March. Here, 20th March 2012. From this date, go back 7 years. That means you go back to March 2005. See whether within this 7 years time period, whether you have done any CLT, that is a chargeable lifetime transfer, or any pet that has now become chargeable due to the death of the person on the 12th of March 2019. This is an important thing to understand. So I am using the nil rate band available at the time of death, but I go back 7 years from the date of gift, and within this time period, if you have done a CLT, you must take it. But if you have done a potentially exempt transfer within this time period, potentially exempt transfer within this time period, potentially exempt transfer within this time period, check whether it's a chargeable pet now. Check whether it's a chargeable pet now. Whether it's a chargeable pet or whether it is an exempt pet. What do you mean by chargeable pet or exempt pet here? Now that means If the donor dies within 7 years, the pet becomes chargeable. If the donor dies after 7 years, the pet becomes exempt. So you go back 7 years from the date of gift. Within this time period, if you have done a CLT, don't think twice. Take that value and deduct it from the available nil rate band. Within this time period, if you have done a pet, don't ignore it at once. Just check whether that pet has now become chargeable or not. If it is chargeable, you take it and deduct it from 325,000. But if the pet has now become completely exempt, in that case, you ignore it and don't deduct it from 325,000. So the purpose of doing this computation is to find out the available nil rate band. Available nil rate band. So that's the purpose of doing this. Okay. So now we will look at the balance computation. So this amount 13,000 is fully covered by the nil rate band. It's fully covered by the nil rate band. Bear with me until I get back to the answer. Yes, so we are there. So you can see my full nil rate band is available for me to utilize 300 and for me to use the available nil rate band of 325,000. So one important thing to remember, nil rate band can be utilized to reduce a chargeable amount to zero, but it cannot create a negative figure. So in this instance, my gross chargeable amount is 13,000. The available nil rate band is 325,000, which indicates I have to use only 13,000 out of this 325,000, and balance will not be utilized. I haven't utilized it yet. So this nil rate band cannot create a negative answer. So the taxable amount is zero. So if there is a taxable amount, IHT must be paid at 40%. IHT must be paid at 40%. But here there is no taxable amount. Otherwise, on the death of a person, you have to pay IHT at 40%. There is no death tax. Death tax is actually 40%, as the gift is covered by the nil rate band. Okay. And then this person has now died on the 12th of March 2019. We need to find out the death estate. Now we are doing the death estate computation. Now we'll read the question again, which indicates how the death estate must be distributed among the dependents of Lewis. So I have made a lifetime transfer in consideration of my son's marriage, which was a potentially exempt transfer. There was no immediate IHT. However, from the date of gift, within 7 years, I died. As a result of that, my pet became chargeable. However, it was fully covered by the nil rate ban. Hence, there was no taxable amount for me to pay IHT at 40%. That is the end of the story. Now we have come to a situation, Louis has died on the 12th of March 2019. According to the last will, this is how his death estate should be distributed. We'll read the question again and see. Louis and Geeta have reciprocal wills, which leaves £85,000 comprising cash and ISAs to each of their children. Excuse. Each of their children, with the residue to each other on the first death. Okay, so now Louis has died. At the time of his death, what did he have in his death estate? He had a main residence of 550,000. Highlight main residence. Building society account 145,150. Premium bonds 27,000. Equity ISAs 125,000. So the total estate value is 847,150. From your death estate, if you give something to your spouse, it is known as an exempt legacy. Even during your lifetime, even on the death of a person, if you leave your wealth to your spouse, that is completely exempt from IHT, we call it an exempt legacy. However, the assets given to your children, they are not exempt, they are chargeable amounts. So at the time of Louisa's death, he has a death estate of 847,150, and the question specifically explains what should be given to his children. What should be given to his children. Now, the only thing that the children must be given are 85,000 comprising cash and ISAs. So he has 3 children. So each child must be given cash and ISAs. We call it individual savings accounts, 85,000 each. So here you can see in my answer, 85,000 pounds into 3. Each child was given 85,000. Out of my wealth, 847,150, I leave 255,000 for my children, giving 85,000 each, and whatever the balance, I will give it to my spouse, which is an exempt legacy, which will not be subject to any taxes. Therefore, the only amount that will be taxed here is 255,000. That is the cash and ISAs given to my children, 85,000 each. Then what am I supposed to do? I have to check on the death estate, is there any nil rate band available? Is there any nil rate band available? I have made one lifetime transfer. Okay. On the death estate, I want to find out what is the nil rate band available. Excuse. I need to find out the nil rate band available at the time of death. When did he die? He died on the 12th of March 2019 during the tax year 2018-19. So that's why nil rate ban at the death. nil rate band at the death, that is during the tax year, 2018-19. This is given to you in the tax table at the exam, which is 325,000, Then what I should do is, from the date of death, now when I'm trying to figure out the nil rate band available on my death estate, I need to go back 7 years from the date of death, because my objective is to find out the nil rate band available on the death estate. Therefore, I need to go back 7 years from the date of death, not from date of gift. So when I go back 7 years from my date of death, within that 7 years time period, I have made one lifetime gift. Again, you can see when I go back 7 years, when I go back 7 years, from the date of death, during that time period, I have made one lifetime transfer. Little while ago, I explained when you go back 7 years like that, due to the death of a person, check whether it's a CLT. If it is a CLT, you take it. But if it is a pet that I have done within that 7 years time period, then I need to consider whether it is a pet, that has now become chargeable or exempt. So from the date of death, I'm going back 7 years like this. Within that time period, I have done a lifetime transfer. What is it? It is a pet. It is a pet. It is a pet that I have done. It is a pet that I have done. If it is a pet, check whether it is exempt now or chargeable. Check whether it's exempt or chargeable. Obviously, it's within the last 7 years from the date of death, so it is chargeable. This 13,000 became a chargeable pet. It's not an exempt pet. Hence, to find out the available nil rate band, what I should do is, bear with me until I get my answer back. Yes, now you can see the screen again. So I go back 7 years from the date of death, and within that time period, I have done a lifetime transfer. If it is a CLT, you always take it. If it is a pet, which has now become chargeable due to the death of the person, you take that as well. But if it is a pet that has now become exempt, then you don't take it. But this is a pet which has now become chargeable due to the death of the person on the 12th of March 2019. So to find out the available nil rate band from 325,000, you need to deduct this 13,000 pounds, which is the gross chargeable amount of the lifetime gift that Louise has done. So you can see it. Available nil rate band is 312,000. However, again, you can see my chargeable estate after the exempt legacy, it's only 255,000 pounds. But the available nil rate band is 312,000. More than enough to cover this 255,000. The nil rate band computation cannot result in a negative figure. It can only be used to bring down my chargeable amount to zero. So there's no taxable amount. That means no IHT payable at 40% on the death estate. So no IHT. So when it comes to Lewis, life is very easy. He made a lifetime gift, no immediate IHT. He died within 7 years, but again, there was no IHT, though it was chargeable because it was covered by the nil rate ban. And then he died on the 12th of March 2019. Still, he has a chargeable estate after the exempt legacy, but still it was covered by the nil rate band available. Hence, on his death estate or on his lifetime transfers, we did not have to pay any IHT. Now we will take Geeta as the other person. Now Geeta's situation is different. She also has made a lifetime gift. When has she made the lifetime gift? Please look at the question. On the 15th of December 2013, she has made a donation to her daughter, Carol, 87,000 pounds. So then again, it is a potentially exempt transfer. So we have to do a normal IHT computation like we did little while ago. Now we are kind of familiar with it. You have to do few questions like this. After that, it's the same thing again and again. And the other important thing is, as I said, only thing is you need to know how to apply the nil rate band available. Okay, anyway, we have another chance to learn it then. So Geeta has made a lifetime gift. Geeta has made a lifetime gift. That was on the 15th of December 2013. During which tax year? 2013-14, and it is a pet. A gift from one person to another person. And she hasn't made any other lifetime transfers, so the current year annual exempt amount is available for you to use it first, and then the previous year one you can carry forward and can use that amount as well against 87,000. Then you have a pet of 81,000 pounds. Again, this is a potentially exempt transfer, therefore no chargeable amount. Hence, there is no chargeable amount for this as well. No chargeable amount. No chargeable amount. There's no immediate IHT. That is what I want to mention here. There is a chargeable amount. There is a chargeable amount. You call it gross chargeable amount here. So this is the gross chargeable amount, 81,000 pounds, but no immediate IHT. No immediate IHT. No immediate IHT. Okay. Then what we have to look at is whether the donor has died within 7 years. Now the question specifically states shortly after the death of Lewis, Geeta also has died. And the question specifically says that all the lifetime gifts are made within 7 years of both deaths. The question specifically states, we don't know the exact date of death of Geeta, but since it's shortly after Louisa's death, we can assume that also occurred in 2018-19 tax year. And further, the question says all the lifetime gifts are made within 7 years of both deaths. Therefore, we have no problem here. This 81,000 pounds becomes chargeable as the donor dies within 7 years. Then again, the same rule we apply with regard to the nil rate band. We have a gross chargeable amount of 81,000 pounds. Now it has become chargeable because the donor died within 7 years time period. So you use the nil rate band available at the time of death. Here, since we are not sure about the exact date of death, since the question says shortly after the death of the person, we can assume she also died within the same tax year 2018-19. So you use a nil rate band available at the time of death. However, when you go back 7 years, you have to go back 7 years from the date of gift. You have to go back from the date of gift. So you can see the gift was made 15 December 2013. From there, you go back 7 years and check whether you have done any CLT within this time period. If you have done any CLT, take it into account. Within this time period, if you have done a PET, first check whether it has now become chargeable due to the death of the person. If it is so, you can take it. But if the PET has become completely exempt due to the death of the person, ignore it. But if it is a CLT that you have done within this 7 years time period, don't think twice, you take it. Anyway, this person has not made any other lifetime gifts other than the gift that we are referring to right now. Therefore, the full nil rate band is available to cover this 81,000 pounds. Therefore, Geeta's lifetime gift, which was a PET, no immediate IHT, became chargeable as Geeta died within 7 years. However, it is still covered by the nil rate band available. Hence, there was no IHT for us to pay at the rate of 40%. All right. Then we need to look at Geeta's death estate. Now again, read the question. So this question is little, not a complicated question, but there are certain things that you can actually learn from this question. Now, if you look at Geeta's death estate, as per the question, she has a building society account, premium bond, equity ISAs, 135,500. In total, how much you have? 371,500. So at the time of Geeta's death, she has a death estate of 371,500. But do not forget, your husband Louis died prior to you, and when Louis died, he gifted from his death. You inherited from his death. You inherited 592,150. Earlier we did that computation. We can see it. You can complete the computation while I'm showing you the answer. So you can see here, on Louisa's death, from his death estate, he left 592,150 to Geeta. Therefore, this 592,150 should be included in Geeta's estate as well. Should be included in Geeta's estate as well. That is 592,150. So then you get a total of 963,650. 963,650. Okay. Now read the question again. The instructions given in the question are extremely important. The question says Louis and Geeta have reciprocal wills which leave 85,000 comprising cash. Louis did that because Louis died first, and the balance he left to his wife Geeta. So Geeta inherited 592,150 on the death of Louis, and now she has on her own 371,500 as well, a total sum of 963,650. What are we going to do that? What are we going to do to this 963,650? What are we going to do? The question says everything to the children in equal shares on the second death. So what Geeta has, everything will be given to her children in equal shares. It doesn't matter, but that indicates everything is chargeable. Everything is chargeable. However, there's a new learning point, that is, as I said, how to deal with the nil rate band. How to deal with the nil rate band. This nil rate band computation is the pulse of inheritance tax computation. Now, the normal nil rate band that I was referring to, is what you have to use at the time of death. Now, Geeta also died in the tax year 2018-19. So she has a nil rate band of 325,000. And do not forget that when Louis died, did he get to use the full nil rate band available? Did he get to use the full nil rate band available? Listen very carefully. This is an important part. That is, every individual is entitled to a nil rate band. In the tax year 2018-19, it is 325,000. But if a spouse dies without getting to use the full nil rate band available, in that case, any unutilized proportion of the nil rate band can be transferred to the other spouse for the other spouse to use on his or her death. I'll repeat it again. If one spouse dies without getting the opportunity to utilize the full nil rate band available, any unutilized nil rate band percentage can be transferred to the other spouse for the other spouse to use on that spouse's death. Now, let me go back. To show you something very important, that is, bear with me until I get it. Okay, now you would see in this question, when Louis died, he had a nil rate band available of 312,000. He had a nil rate band available of 312,000. From that, he was able to use only how much? He was only able to use 255,000. 255,000. There's an unused nil rate band here. There is an unused nil rate band. 312,000 was available. Actually, the nil rate band available at the time of death was 325,000. But from that, for the lifetime gift, we had to use 13,000. We had to use 13,000. So there was a nil rate band available of 325,000. And from that, for the lifetime gift, I had to use 13,000 pounds. Then there was a balance of 312,000 at the time of the death. And from that also, I had to use 255,000. Then there is a difference. Then there is a difference. Now, that difference, I'll show you the figure. Bear with me. It's become slower than I expected. So you can see I have my nil rate band available, 325,000. However, Lewis had a available nil rate band of 312,000 at the time of his death. From that, if we look at note number 2, so here this is the computation. I had 325,000. Lewis had 325,000 at the time of death. For the lifetime gift, he had to use 13,000. For the death estate, he had to use 255,000. And there was a remainder of 57,000. Now that 57,000 you can transfer to your spouse, Geeta, on your death. But a very important thing to remember. Now here I got the answer as 57,000. That is true. I got the answer as 57,000 as a numerical answer. But remember, this is not how we should calculate this amount. In order to calculate this amount, what we should do is we should take it as a percentage. So you should never forget this. This is an important thing to remember. That is, this is not a numerical, this is not an absolute figure. It has to be a percentage. This is how you should do it. When you're calculating this 57,000, ideally, the calculation should have been like this. The calculation should have been like this. That is, I had a nil rate band available at the time of my death, 325,000 pounds. 325,000 pounds. Out of this, I had to use, out of this 325,000, I had to use 13,000 and 255,000. 255,000. So I'll do it here. $325,000 was the nil rate band available. For the lifetime gift, I had to use 13,000, and 255,000 I had to use for the death estate. Then I get a balance. That gives me the unutilized nil rate band out of 325,000. I had a nil rate band available of 325,000 at the time of death, but from that I had to use 13,000 for the lifetime gift and 255,000 for the death estate. Then I have a balance. Now that you have to multiply by 100, then you get it as a percentage. Or else, instead of using it as a percentage, what you can do is, another way to get the answer is, you should multiply it by, one way of doing it is, as I said, multiply by 100 and get it as a percentage. Whatever the percentage that you get, then what you should do is, that percentage you apply here. That percentage you apply here. That is, at the time of your death, at the time of Geeta's death, what's the nil rate band available? 325,000. To that amount, you apply whatever the percentage that you got here. This percentage you apply here. Then the answer that you get, still it will be 57,000. It will be 57,000. That's how we should get the answer. I'm explaining this because sometimes you can come to the wrong conclusion thinking that it's the absolute figure that we should take into account. It's not that. It's not the absolute figure that we should take into consideration. It's the unused percentage that we calculated here must apply to the nil rate band available at the time of second spouse's death, and that's how you should get the answer. So this is an important thing for you to remember. This has been tested several times at the exam, something you cannot ignore, right? So spend enough time to understand this. And then on the other hand, so Geeta has a nil rate band of 325,000 on her own, and then the unused nil rate band from Louis 57,000. Altogether, she has a nil rate band of 382,000. But Geeta has made a lifetime transfer worth of 81,000. Therefore, 382,000 should be reduced by 81,000 pounds. Then you get 301,000 pounds. So that is a nil rate band available in that situation. But another important thing to remember, in the tax year 2017-18, they introduced another type of nil rate band, which is known as residence nil rate band. It is known as residence nil rate band. So what is this residence nil rate band? This is a additional nil rate band for the current tax year 2018-19. The residence nil rate band available is given in the tax table. It's 125,000 pounds. But for you to claim this additional residence nil rate band up to a maximum of 125,000, the main condition that you have to satisfy is that you have to gift your main residence to your direct dependents. You have to have a main residence, and that main residence you should give to your direct dependents. What do you mean by direct dependents? Remember, for this purpose, direct dependents are only children and grandchildren, not anyone else, children and grandchildren only. So if you give something, not something, if you gift your main residence to your children or to your grandchildren, then you can use a residence nil rate band of £125,000. Not only that, this main residence initially owned by Louis, not Geeta. Geeta actually inherited, if you read the question, you will see the main residence was actually owned by Louis initially, 550,000. And on the death of Louis, it was inherited by Geeta. Hence, Louis also had a residence nil rate ban, which he didn't have to use because except for 85,000 cash for each child, everything else, the main residence, everything, Louis gave to his spouse Geeta. Therefore, it was an exempt legacy. Louis did not have to use the residence nil rate band of 125,000. Any unutilized residence nil rate band, like I explained here, like I did the computation here, like I did the computation here, you need to find out the unutilized residence nil rate band. Here, 100%. Why? Louis did not have to use his residence nil rate band because the main residence was given to his wife, which was an exempt legacy, so he didn't have to use his residence nil rate band. So 100% of that 125,000 can be transferred to Geeta for Geeta to use on her death. So that is why in the answer you can see two residence nil rate bands here. Two residence nil rate band. One is Geeta's, the other one is Louise's. So this is 250,000 altogether. But one important thing to remember, the residence nil rate band can only be used against the main residence value. So here you have your residence nil rate band of 125,000, Geeta's residence nil rate band of 125,000. Altogether you have 250,000, but the maximum you can use cannot exceed the value of the main residence. You have 250,000. Luckily, your main residence value is 550,000. Therefore, you can use the full amount, 250,000. But if you have a situation where, if you have a situation where, if you have a situation where the full residence, the main residence value is less than 250,000. Assume your main residence is only 200,000. Though you have 250,000 here as your residence nil rate band, if the main residence value is less than 250,000, then you have to limit to the value of the main residence. Otherwise, you can go up to a maximum of 250,000 here without any problem. So this is how you calculate the available residence nil rate band. So 250,000 and here 301,000, and the taxable amount is 412,650. On the death estate, you have to always pay taxes at 40%. That will be the IHT payable here. That will be the IHT payable here. So you can see 165,060 is the IHT payable amount in this situation. Then from IHT, we'll answer the next question as well. So then we can complete inheritance tax. As I said, when it comes to inheritance tax, understanding the format, understanding the application of nil rate band, including residence nil rate band, how we can utilize the unused nil rate band and unutilized residence nil rate band of the spouses who have died first, are the most important elements of inheritance tax. So we have a simple and straightforward question. Question number 11 in the question tube that has been shared with you. Lynn Watson, that question, we read it. Required, calculate the IHT arising from the gifts made by Lynn during her lifetime and on death, assuming she were to die on the 31st of January 2019. Your answer should include the relevant due dates for payment of the tax. The nil rate band figures are given: 8-9, 312,000, 11-12, 325,000, 12-13, 325,000. So Lynn Watson has asked for your advice regarding the following gifts that she has made. On 25th of September 2008, Lynn made a cash gift of 341,000 into a trust. What is it? This is what we call a chargeable lifetime transfer. So that was on the 25th of September 2008, and we will look at the answer for that question also. Yeah, so we will, this is the answer. So he has made a gift. Again, take them according to the chronological order. This is the exact method that you should use at the exam as well. So there's a CLT, gift to trust, 25th of September 2008. Then transfer of value is 341,000. On the 9th of February 2012, that is during the tax year 2011-12, Lynn made a gift to her son 5,500 £1 ordinary shares in Mega Limited, an unquoted investment company. Lynn held 15,000 shares prior to the gift. There are 20,000 shares in issue. Okay. Now, here the transfer of value is not given. We need to find out the transfer of value. How to find it out? As I said, the basis of assessment for the purpose of IHT is not finding out the value of the shares we have gifted. No, what we have to look at is what was the shareholding value of Lynn before making the gift? What is the shareholding value after making the gift? So we'll look at the working. So before making the gift, he had how many shares in this company? Please read the question. He had 15,000 shares in the company. The total number of shares in issue in the company was 20,000. Take it as a percentage. 15,000 divided by 20,000. 15,000 divided by 20,000. This is how you get the answer. So we have 15,000 divided by 20,000 into 100. So as a percentage, you get 75%. So before gifting in this company, he had a shareholding of 75% or more. So if the value of the shareholding is 75% or more, what is the value of a share? Look at the question. The answers are given. It's 20 pounds. So likewise, he had 15,000 shares before making the gift. That means the total value of the shareholding was 300,000. Then from that, what he did was he had 15,000. From that 15,000, he gifted 5,500, 5,500, 5,500 to his son. Now, after making the gift, what is the percentage? 15,000 minus 5,500 divided by 20,000, divided by 20,000, and convert into a percentage. There you get, I think, approximately 47.5%. 47.5%. So if you have 26 to 50% of the company, what is the value of a share? The value of a share is 8 pounds. And likewise, after making the gift, you have only 9,500 shares in the company. Therefore, the total value after making the gift is 76,000. Simple logic. Before I made the gift, my shareholding was worth 300,000. After making the gift, my shareholding is now worth 76,000. My shareholding value has gone down by 224,000. That is what we call the transfer of value. This is the basis of assessment for the purpose of IHT. Okay, so you can see that's how we calculate transfer of value there. So that is a pet. Then we have another one. See, third one. On the 28th of February 2013, Lynn made a gift to her daughter of a holiday home worth 269,500, another potentially exempt transfer. Except for the first one, the rest are pets. So transfer of values are given. We have recorded the dates according to the chronological order, starting from the earliest one. The first one occurred in 2008-9 tax year. Previous year 7-8, you can use the annual exempt amount for the current year and the previous year. Then you have a chargeable amount of 335,000. It's a very important thing. This is the chargeable amount. I'll come to that in a while. Then the other two are pets. They are 2011-12, 2010-11, 12-13, 11-12. Yeah, so 9th of February 2012, that is during the tax year 11-12, you can use 3,000. Previous year 10-11, you can use that 3,000, and then you get a chargeable amount of 218,000. So this is the gross figure. This is the gross figure. That is because this is the gross figure because it's a pet, no immediate IHT. And then there's another pet that we have made. So for that, we can use 12-13 annual exempt amount. However, 11-12-1, we have nothing to use because we have used it in the previous year. I hope you understand that simple explanation. So then you have 266,500 where you get the gross figure of 266,500. For pets, it is always the gross figure that you get. For pets, it's always the gross figure that you get. But what about this CLT that we have done? Now there is a chargeable amount of 335,000. There's a chargeable amount of 335,000. The question is whether this 335,000, is net or gross. People who have studied properly should be very well aware that whether this is gross or net depends on who is going to pay tax on this. Who's going to pay taxes? Because it's a CLT. If it is a CLT, there is an immediate IHT. If it is a CLT, there's an immediate IHT. Therefore, someone has to pay that IHT. If the donor is going to make the payment, then the chargeable amount that we get here should be treated as net. But if the trustees are going to pay, the answer that we get here should be treated as gross. Further, if the donor is going to pay IHT, then the rate applicable is 25%. If the trustees are going to pay IHT immediately, then it should be taken as 20%. So that's how you do the computation. Now, on 25th of September, Lynn made a cash gift into trust for the benefit of her grandchildren. You can see in the question, she is to pay any IHT liability arising from the gift to the trust. So Lynn has agreed, the donor has agreed to pay IHT. If that is the case, the answer that you get here is always the net figure. And finally, you have to pay taxes at which rate? 25% as well. So you can memorize this actually. Anyway, for pets, no immediate IHT, but for CLTs, there can be immediate IHT. Therefore, you need to use the nil rate band available at the time of gift. This gift was made on the 25th of September 2008 during the tax year 8-9. Look at the question. The question says 2008-9, the nil rate band available is 312,000. Now, from the date of gift, you go back 7 years and see whether you have done any CLT only. I'll repeat again. Here, this is a lifetime transfer. Donor hasn't died yet. If it is a lifetime transfer, from the date of gift, you go back 7 years and you take only CLTs. Only CLTs are taken into consideration here because you are not dead. The donor has not died. If the donor has died only, you have to see whether it's a CLT. If it is a CLT, you take it. If it is a pet that has now become chargeable due to the death of the person, you take it. If the pet has become exempt, you don't take it. But now that problem will not arise because the donor has not died. He's very much alive. He has made a lifetime transfer. Then from the CLT, which is subject to immediate IHT, you go back 7 years. And within that 7 years, if you have made another CLT only, you take it. If there is any pet during that 7 years time period, you completely ignore it. Right? So anyway, there are no CLTs made previously. Therefore, the full nil rate band available. However, that is not enough to cover the full chargeable amount, 335,000. Therefore, there is a balance of 23,000. There's a balance of 23,000. On that 23,000, as I said, since the donor is going to make the payment, you have to pay taxes at 25%. 25% you have to pay. That means you have to pay 5,750 IHT immediately. So that's the situation for the lifetime transfers. Okay, there's immediate IHT. Then a very important thing occurs. We need to carry forward the gross chargeable amount here. the gross chargeable amount. Gross chargeable amount must be carried forward. But here we have the net chargeable amount. So how do we calculate the gross chargeable amount? You can tell me. So to the net chargeable amount, when you add the lifetime IHT together, that is 335,000 plus 5,750, you get the gross chargeable amount, which is 340,750. That is the amount we should carry forward if we have got the net chargeable amount. You get the net chargeable amount only if the donor has agreed to make the payment. If the donor has agreed to make the payment, then it's a net amount, plus you must pay IHT at 25%. To get the gross amount, you must add the net chargeable amount and the lifetime IHT paid immediately. Okay, then what has happened? Then we have to assume that Lynn has died on 31st January 2019. Then what you should do is, from the date of death, go back 7 years. This kind of questions are very common at the exam. So you go back 7 years from the date of gift. You go back 7 years from the date of gift. So this is the time period we have to cover. This is the time period. 31st January 2019 to 31st January 2012. When you go back 7 years, except for the first CLT made, the other two gifts, the second gift and the third gift, they are within this time period. The second gift and the third gift are within this 7 years time period, except for the first CLT that we made. That means first CLT is not subject to further IHT. There was immediate IHT on the first CLT, but no further IHT because the donor has died after 7 years from the date of gift. But if you look at the second and the third gifts, they were pets, no immediate IHT, but now the donor has died within 7 years time period. Therefore, both pets have now become chargeable. Hence, you need to calculate the IHT liability on these two pets. So if you take the first pet, that is on the 9th of February 2012. Gross chargeable amount we have already calculated previously, 218,000. Important. Now you need to take the nil rate band available at the death, not at the time of gift, which is 325,000, because you died 31st January 2019 during the tax year 2018-19. All right, so that is 325,000. However, you need to go back 7 years from the date of gift, not from the date of death. So that means from 9th February 2012, you go back 7 years. That is up to 2005. Now, when you go back 7 years, now you check whether it's a CLT or PET. If it is a CLT, don't think twice, take it. So when you go back 7 years, we have made a CLT for 340,750. We have already calculated within that 7 years time period. So you have a nil rate band of 325,000, but there's a gross chargeable amount of 340,750. Another thing to remember, the nil rate band can never be minus. Either you have the nil rate band or it will be reduced to 0. This indicates I have fully utilized my nil rate band, so there's no available nil rate band for me to use. It's 0. As a result of that, Now I need to pay inheritance tax on the full amount, 218,000, at the death rate, which is 40%. So you can see IHT payable at 40% on the full amount, 218,000, which is 87,200. A very important thing to remember. A lifetime transfer has become chargeable due to the death of the person. In that case, there is a very special relief available. We call it taper relief. Taper relief. Taper relief is available if the time period between the date of gift and the date of death exceeds 3 years. The time period of the gift and the time period between the date of gift and the date of death, if that exceeds more than 3 years, then the taper relief is available. It will be given to you at the exam in the tax table. Accordingly, if the time period between the date of gift and the date of death is 3 to 4 years, then you are entitled to a rate of relief of 20%, 4 to 5 years, 40%, 5 to 6 years, 60%, 6 to 7 years, 80%. Now, here the gift was made 9th of February 2012 and he died 31st January 2019. So what's the time period between date of gift and the date of death? The time period is 6 to 7 years. Therefore, 6 to 7 years, the relevant percentage is 80%. That means from your IHT liability, which is 87,200, 80% will be waived off. Out of 87,200, 80% will be waived off. Only 17,440 we will have to pay. After the taper relief also, don't forget there is another relief available, that is during the lifetime. If you have paid any IHT, you can deduct it. However, since it's a pet, there cannot be lifetime IHT. But you can have the taper relief depending on the time gap between the date of gift and the date of death, as I explained here. So IHT payable is 17,440. And one more thing, taper relief or IHT lifetime paid can only be used to bring down your IHT liability to 0, because you will never be able to have IHT refunds. There's nothing called IHT refunds. So because of that, remember, IHT can only be reduced to 0 with the help of the taper relief and the lifetime IHT paid. And the question specifically states, mention the due date for payment as well. Mention the due date for payment as well. Normally, since it's on the death of a person, from the end of the month he died. When did he die? He died on the 31st January 2019. 31st January 2019. From the last date of the month he died, take 6 months. Take 6 months, that is 31st July 2019. So by 31st July 2019, the person who received the gift must pay this 17,440. So who received the gift? Son of Lynn received the gift, so he must pay it. Likewise, now you can calculate the IHT liability on the third pet that we made. So that took place on the 28th of February 2013. The gross chargeable amount was 266,500. And as usual, take the nil rate band available at the time of death. From the date of gift, 2013, go back 6 years. Within this time period, if you have done any CLT, take it. Within this time period, we have done a CLT. Can you remember the very first CLT? That was 340,750. And within the same 7 years time period, we have done a PET as well. We have done a PET as well. Now that PET is now chargeable. Here, this PET, gift to son. So from 28th of February 2013, you go back 7 years. Within that time period, if you have done a CLT, you take it. So what's the CLT that we have done? The first gift we did was a CLT. That value was 340,750. You take that. And within the same 7 years time period, we have done a PET also. That is this PET, which we did on the 9th of February 2012. It's within this time period. If it is a PET, don't take it if it has now become exempt. But this PET didn't become exempt. It became chargeable. Therefore, you have to take this 218,000 also. So 340,750 plus these two, you add it together. You add them together. Then you get this answer 558,750, which indicates I have no nil rate band available. They have been fully utilized. Therefore, on the full amount 266,500, I must pay IHT at 40%. 266,500 at 40%, I must pay 106,600. Then check whether the taper relief is available. So from the date of death to date of gift, what's the time duration here? 2013 February to 31st January 2019. The time gap is 5 to 6 years. 5 to 6 years. If it is 5 to 6 years, the applicable percentage is 60%. Out of 106,600, 60% is waived off. So I have to pay only 42,640. There's no lifetime IHT paid again since it's a PET. So the person who received the gift, that was the daughter of Lynn, must make the payment on or before 31st of July 2019. So these are the type of questions normally you do get at the exam. Quite common for you to get this kind of question. So it's worth spending your time. And it's actually within a very limited time period. It's not that easy to explain all the elements. I can only explain the basics and some of the important aspects of the areas within the time period that have been given. So anyway, I was planning to discuss value-added tax, but due to time constraints, I won't be able to discuss value-added tax today. I may try to discuss a little bit of value-added tax tomorrow, but tomorrow mainly I focus on corporation tax and individual income tax computation. So if we find some spare time, I will try to explain a little bit of value-added tax as well. But as I said, I will be mainly focusing on corp tax and individual income tax computation. So, so within this time period, I explained some main elements of CGT and inheritance tax. At the exam, altogether, you will be able to score 25 to 30 marks from this area, both IHT and CGT. Therefore, I request from all of our students to spend enough and more time to learn all these main elements with regard to CGT and inheritance tax, because it's definitely worth spending time. It's a good investment when doing taxation. So thank you very much for listening. So see you tomorrow again at 2 o'clock with corp tax and individual income tax computation. Until then, good evening to all of you. study really hard within the next few weeks that you are having. So thank you very much for listening once again. See you tomorrow at 2 o'clock. Goodbye.